We hear it every day. The AI bubble is going to pop. Washington is in chaos. Everyone is hyper-analyzing Jerome Powell's press conferences like they're waiting for a new GTA 6 trailer. It is the standard doom-scrolling menu. And if you pay attention to that menu, you are probably pretty frustrated right now, because the Federal Reserve can sit there and talk about cutting rates all they want. But out here in the real world, mortgage rates refuse to fall, and financial conditions still feel incredibly tight. Here's the problem. While the Fed has some indirect influence, what they actually control are short-term rates, the overnight rate. They do not directly set the 10, 20, or 30-year bond yields, which are the exact rates that dictate your everyday borrowing costs. The financial media apparatus is staring at the wrong lever. The true price of money, the baseline that anchors the global economy, is determined largely by global supply and demand. And right now, the biggest shift in that supply and demand doesn't start in Washington. It starts in Tokyo. More specifically, it revolves around the most boring asset on Earth, Japanese government bonds. You likely haven't heard much about them unless you've gone deep down the finance rabbit hole. But for the past 30 years, Japan has quietly acted as the duct tape holding the global financial system together. Now, after 3 decades, that structural duct tape is finally peeling off, and the implications for global markets are severe. To understand why Japan matters so much today, we have to rewind to 1992. Japan's massive asset bubble burst. Real estate collapsed, equities crashed, and the country entered a 3-decade period of zero growth and stagnation known as the Lost Decades. With no options, the Bank of Japan cut rates to zero, supergluing long-term yields to the floor. For a Japanese pension fund, a 0% return is a mathematical crisis. They had to shop overseas to find actual yield. This birthed what became known as the yen carry trade. Investors would go to Japanese markets, borrow yen at near zero interest rates, and convert that cash directly into US dollars. They would then take those dollars and buy US Treasuries that yielded 4 or 5%. After paying minimal hedging costs, they simply pocketed the spread. It was virtually free money. Because the math worked so perfectly, investors executed this trade at a staggering scale. The volume eventually reached into the trillions, turning Japan into the world's ATM and making them the single largest foreign holder of United States debt. For decades, this continuous one-way pipeline of capital served as the absolute cheapest source of liquidity on the planet. If an asset had a pulse and yielded more than 0%, this Japanese capital bought it, artificially inflating asset prices everywhere. But the entire system relied on one assumption, that Japanese yields would stay at zero forever. In 2024, the Bank of Japan raised interest rates. When Japanese yields rise, the math instantly flips. Borrowing in yen becomes expensive, hedging currency risk becomes expensive, and suddenly that clean, risk-free profit margin is completely wiped out. This triggers an event called repatriation. The capital that steadily flowed out of Japan for decades is now rapidly reversing course and rushing back home. The market reaction was violent. Following the second rate hike, the S&P 500 dropped 6%, and Japan's Nikkei index plummeted over 12% in a single day, marking its worst drop since 1987. The era of free money is closing. Investors are waking up to the uncomfortable reality that global markets have spent decades entirely dependent on this single Japanese lifeline. To see how this hits home, look at the United States Treasury. The US government is running trillion-dollar deficits, meaning the Treasury has to issue massive amounts of new debt every single year just to fund the government. As that debt pile grows, someone has to absorb it. Historically, Japan was one of the most consistent buyers of that debt. If they step away from the table, we are left with a severe supply and demand imbalance. The mechanics here are straightforward. If you have a massive supply of bonds and fewer buyers, the Treasury is forced to offer higher yields to attract new capital. This creates a steepening yield curve. The Federal Reserve can cut the short-term federal funds rate all they want, but global market forces pin the long-term rates relentlessly high. And that 10-year Treasury yield is the foundation for almost everything else. It anchors the housing market. So if global demand for our debt weakens and the 10-year yield stays elevated, your local mortgage rate isn't going to magically drift back down to 3%. Housing affordability stays strained. These same yields act like gravity on the stock market. Analysts value stocks by projecting future cash flows. and they discount those cash flows using long-term yields as a baseline. When those yields stay high, the present value drops, compressing stock valuations across the board. Zoom out to corporate credit, and the math applies there too. High borrowing costs strangle business risk appetite. Deal flow slows down, growth stalls, and capital tightens for companies of all sizes. As Ray Dalio notes, the bond market is the backbone of all markets. It provides the baseline interest rate that dictates what the returns of every single asset class are going to be. Liquidity is the oxygen of the financial markets. The actual threats to your portfolio are rarely the loud, clickable headlines you see on the news. The real danger is the silent, massive shift in global capital flowing far beneath the surface.